So, good day, guys. This would be our discussion for our final topic in management accounting, which is working capital management. So, this would be for the entire final term for management accounting. This would revolve around general working capital management concepts, management of cash and marketable securities, trade receivables, inventory management, and management of short-term liabilities. So this would be a mixture of problem solving and theoretical concepts. So to start, what is working capital management? So this deals with the firm's short-term or current assets and liabilities. Why do we need to manage our working capital? The thing is, we want our assets or our resources to be utilized in such a way that they would produce output or value. They would add value to our company. When an item is maintained in the current asset section or working capital section of an organization, it remains to be idle. It means it does not produce any benefit while it is in the current assets or working capital of the company. Take note of that. The thing is, when an item, like for example cash, when cash is held by the company and under current assets, it does not do anything. It does not earn, it does not let you earn. While if you would let that cash go and say invest in a productive asset like a lot or a machine that would contribute towards the company's profit earning motives, then it would be a product. It would generate revenue or income for the company. However, we cannot we cannot entirely work on with a company that has no current assets or working capital. The thing is, working capital is necessary for the day-to-day operations of the organization. Now, if we would have too much working capital, we would have too many idle resources. But if we would have no or too few working capital, we would have an organization or company that would have liquidity crisis. So working capital represent the portion of investment that circulates from one form to another in the ordinary conduct of business. So we need these resources so that we can sustain the company's day-to-day operations. But take note, we just need a sufficient amount of this. And we do not need actually too much, like too much cash, too much inventory. Remember, when an inventory remains to be part of the inventory, it is still unproductive. When does inventory become productive? When it is sold. So we have different reasons for holding cash or resources within the entity. The first one is speculative motive. So the thing is, we might encounter something that is productive in the long run. So we need to have cash available whenever those opportunities arise. So that is one motive of holding cash available. Next one is precautionary motive, the need to hold cash as a safety margin to act as a financial reserve. We need to provide our lenders security that we will be able to pay our liabilities as they become due. Or better yet, we need our suppliers to be sure that we will be able to pay. If we do not have that amount of cash readily available, then they might doubt our capability to be customers to them or borrowers. In that note, transaction motive, the need to hold cash to satisfy normal disbursement and collection activities associated with the firm's ongoing operations. As mentioned earlier, we are maintaining current assets or working capital within the organization to make sure that the company continues and is up and running and is always ready to disburse whenever the need arises. So the thing is, in working capital management, we need to have a balance between profitability and risk. What is profitability? That is the relationship between revenues and costs generated by using the firm's assets in productive activities. Therefore, if the amount that is tied in working capital is released from working capital and is used towards other investments that would lead to the company earning profit, then that increases the company's profitability. However, that profitability advantage would also have a risk that is attached with it, or the risk of insolvency, the probability that the firm will be unable to pay its bills as they come due. So in here, when our current ratio increases, the effect in profit the profit would decrease because we have too many current assets invested in our company, but the risk also decreases because the risk of insolvency decreases because we have too many funds available for our for the lenders or for our creditors to make sure that the liabilities are fulfilled. However, when this ratio decreases, we are investing this amounts or these profits to more profit generating activities, which would increase our profits and in turn have an increased risk of insolvency because we do not have that much fund available. While the ratio of current liabilities to total assets, when that increases, we have too many currently maturing loans and not much of if we do not have that much of current assets to cover these current liabilities, we have an increased risk. However, since these current assets are currently tied up with other profit generating activities of the firm, we have an increased profit, and that has an inverse effect when the ratio of current liabilities to total asset decreases. Therefore, we need to have that perfect balance of working capital that is invested in an organization so that we do not put our resources to waste while we are able to manage that risk of insolvency. That would be the entire nature of our discussion regarding working capital management. So, for illustration, let us answer this problem. So, the problem states, management of a company does not want to violate working capital restriction contained in its bond indenture. If the firm's current ratio falls below 2:1, technically it will have defaulted. The firm's current ratio is now 2.2:1. If current liabilities are 200 million, the maximum new commercial paper that can be issued to finance inventory expansion is. So in here, we have a current ratio that is currently 2.2. So our current ratio is 2.2, which is, what is the formula of current ratio? Current asset divided by current liabilities. So to be able to utilize this, we have our current liability. So 2.2 is equal to, we don't have our current asset account yet, and our current liability is 200 million. So to be able to determine the current asset, that is 2.2 multiplied by 200 million, we have, so that is 2.2 times 200 million, 440 million. So that is our current asset, 440 million and current liability of 200 million. Now, the maximum new commercial paper that can be issued to finance inventory expansion is, what would be the effect of that commercial paper? So that commercial paper will increase your current liabilities because it's a commercial paper. It will mature within the year. However, that would be used for inventory expansion. So that would increase inventory, which would increase your current asset. So to determine the maximum amount that commercial paper that we can issue, the current ratio must remain at 2.0 is equal to our current asset of 440 million will be increased by that amount. So let that be X. And our current liability of 200 million will be increased by that amount as well. So that is 2.0 is equal to 440M plus X divided by 200M plus X. So cross multiply. 2 multiplied by 200M plus X is equal to 440M plus X. So we have 400M plus 2x is equal to 440m plus x. We transfer the amounts. So there we go, and then we put x on the other side. 2x minus x is equal to 440m minus 400m. So x is equal to 40 million. So that is the amount of new commercial paper that we can issue. Next would be, so this means that in managing these the current assets and current liabilities of the company, we can issue up to 40 million of commercial paper and will not still violate the covenant, which is to maintain a current ratio of 2.0. So let's answer this next problem. A corporation has 100,000 shares of stock outstanding. Below is part of A's statement of financial position for the last fiscal year. What is the maximum amount A can pay in cash dividends per share and maintain a minimum current ratio of 2:1? Assume all accounts other than cash will remain unchanged. So in here, we have our current assets. How much would be our current assets in this? We have 455,000 plus 900,000 plus 650,000 plus 45,000. So we have 695,000 for current assets, and our current liabilities, that would be 285 plus, let's repeat that is 455 plus 900 plus 650 plus 45. That is rather 2,050,000 for current assets, and our current liabilities, that would be 285 plus 550 plus 65. We have 900,000. So the question here is, how much can you pay as dividends? So what would be the effect of dividends in this scenario? That would be cash dividends, that would decrease current asset. How about current liabilities? What would be the effect? That is no effect, because it would be paid in cash. So that is decrease in current asset, and actually an effect in decrease as well in retained earnings, since that would be the part that would be the entry, that would be debit to your retained earnings as part of distribution of earnings for the stockholders. So therefore, our formula here is we should maintain a minimum current ratio of 2.0. That is 2,050,000 minus X amount divided by 900,000. So that is cross multiply 2 times 900,000 is equal to 2,050,000 minus X. So that is 1.8 million. And then 2,050,000 minus X, and we transpose, and we have our X is equal to 2,050,000 minus 1,800,000. So that is 2,050,000 minus 1.8, that is X would be equal to 250,000. That is the total amount of dividends, the total value of the dividend. We divide that by the number of shares, which is 100,000 shares. So the dividend is 2.50 per share. So that would be our answer. So we need to take note that in this scenario, we need to be aware of how much do we maintain in our working capital so that we will be able to manage our working capital accordingly and in a more efficient manner.